Hello, everyone. Good afternoon. This is Preeti Sardeshmukh, NRI and foreign income taxation expert from TaxBuddy. Today, we will discuss about the RSU or restricted stock units, that is commonly known as RSUs, income generated from it, and taxation of the RSU. So, first of all, what is the concept of RSU? RSU is a stock of shares which is given by the company to its class of employees as a compensation on fulfillment of certain conditions. So, concept of RSU is a different from the employee stock exchange, that is ESOP. Generally, multinational companies and foreign companies issues RSUs on the fulfillment of certain conditions. The conditions are specified at the time of their employment only, and the shares are granted to the employees, and the shares will be vested over a period of years, several years, upon the fulfillment of all those conditions which are specified. So, to understand this, we will take one hypothetical example. Company X granted 1,000 stock units on first year of employment to Mr. A. So, these 1,000 stock units, basically 1,000 shares, are granted to Mr. A as a compensation, but these are not the shares which A can freely trade, A can sell those shares, or A cannot earn dividend on those shares. So it means whenever shares are granted to the employee, the employee is not free to deal with those shares. He is eligible to deal with those shares only after when the shares will be vested to him, and he will be able to earn the dividend if company distributes dividend on that stock. Unlike ESOP, employee stock option, unlike ESOP, RSUs are vested free of cost. There is a no cost recovered from the employee by the employer or by the company. So RSUs are vested to the employee free of cost. And even though even though RSUs are vested free of cost, but there is a non-monetary benefits added to the salary of employee. And and even though RSUs are not the monetary benefit, but it is a part of income of the salary of employee. So now we will discuss about the taxation of RSU, and we will discuss some example for more understanding. So for taxation of RSU, we need to check whether the shares, that is a stock of RSU, are granted to the employee or vested. If the shares or stock are only granted to the employee, then there is a no tax implication in that year in the hands of employee. The tax implication will arise only when shares are vested to the employee. And after vesting, there are two incidences of tax: at the time of vesting of stock and at the time of sale of stock. So, first incidence, at the time of vesting of stocks, stocks are transferred to employee's account at the value of stock as on date, that is fair market value as on date of vesting. And basically, perquisite is calculated by the employee, and whatever tax liabilities arises on that amount, that is deducted by employer. Uh, for that purpose, number of shares into fair market value and conversion rate to the INR is considered. And the arising amount, the calculated amount, will be added to the salary or taxable income of employee, and it will be taxable in India, and that income will be reflected in Form 16 of the employee. And whatever TDS is deducted by the employer, that the employee can claim as a TDS in his income tax returns. Further, there are three methods to deduct the tax, and out of two are majorly used. So, first method is the to deduct the TDS, employee deduct the certain percentage of shares from the employer deduct certain percentage of shares from the total vesting units, and he sells off those shares, and the proceeds are utilized to meet up the tax liability, and balance shares are transferred to employee. So this method is commonly known as sell to cover method, and this method is majorly utilized in the India. So basically, when, for example, if any employee is getting is vesting 200 shares in the financial year, then out of 200 shares, 30% shares, suppose 30% shares are deducted by employer for the to meet the tax liability. Then employer will deduct the 30% shares, that is 60 shares from his 200 shares. He will sell those shares, and the sell proceeds will be utilized to meet up the tax liability, and remaining 140 shares will be transferred to Mr. A. The out of the two methods, second method is tax is deducted in cash and whole number of vested shares are transferred to employee uh, to his account. So basically, as per our example, if 200 shares are vested to Mr. A, so uh, whole 200 shares will be transferred to Mr. A, and tax will be deducted in cash as per the slab rate, and the perquisite value will be calculated on the as on the date of fair market value as on date of vesting date, and to conversion rate as on date of vesting date. So basically, there is a no double taxation at the time of vesting. If there are any shares are deducted by employer, any percentage shares are deducted by employer, then that shares are deducted to meet up the tax liability in India only. That is not deducted for the purpose of to meet the tax liability outside India, or whatever country of the company. So sometimes people holding RSU have some questions like, I did not receive all the shares. I received the percentage of share and percentage shares of deducted by employer, and that was against some kind of tax liability. But even though it is deducted against tax liability, but that tax liability is Indian tax liability only, and that will reflect in your Form 16 as a TDS, and you will claim the TDS in your income tax return. Now move on to the types of income from the RSUs, and we will see some examples for the understanding. So after vesting of RSUs, employee is free to deal with those stocks. So basically, once the employee gets the shares transferred to his account, we can deal to the share with the shares as per his opinion. If he wants to hold those shares, then he can hold the shares, or if he wants to sell off the shares and get the sell proceeds, then he can do the same. So the two possibilities are either employee can hold the stock, or employee can sell the stock. If employee hold the stock, then in case of certain companies, some cases company may pay dividend, may distribute the dividend, and that dividend is a dividend income in hands of employee. Second possibility, employee can sell the stock. So if employee sells the stock, and then in that case employee earns capital gain in his hand, and that capital gain is taxable in India. So now capital gain has two types of capital gain, that is short-term capital gain and long-term capital gain. So whether the earned capital gain is a short-term or long-term, it depends on for how much period employee held the stock. So if employee holds the stock for more than 2 years, then capital gain will be long-term capital gain. If employee sells the stock within 2 years, that is before completion of 2 years, then the capital gain will be short-term capital gain. So, for example, if in case any stock is vested to Mr. A for in the year of 2022, so if he sells that stock before 2024, then the capital gain, whatever capital gain he will earn, that will be considered as a short-term capital gain. And if he sell that stock after 2024, then the capital gain he will earn will be considered as a long-term capital gain. And the taxation implication will be different for the long-term capital gain and short-term capital gain. That is why it is very important to understand whether the after selling of RSUs, whatever capital gain is arising, you need to understand whether it is a long-term capital gain or short-term capital gain. And accordingly, you have to calculate the tax liability and declare it an income tax return. Now move on to the taxability of income generated from RSU. So now if employee, like we discussed earlier, if employee holds the share, then he receives the dividend income in certain cases if company distributes the dividend. So suppose in our case, company is distributing the dividend. So the employee is receiving the dividend. In that case, that dividend is taxable in India. Since employees having a resident status, that dividend is, even though it is outside, it is earned outside India, it is a foreign dividend, but it will be taxable in India. And the employee has to report this dividend income into his income tax return. And he has to calculate the tax liability. And if there is any tax deducted or tax withheld outside India, then he has to calculate the foreign tax credit as per the provisions of DTA, and he can claim that foreign tax credit in his income tax return, subject to certain conditions to avail the benefits of foreign tax credit. Second possibility, if employee saves the stock after 2 years of holding. So in that case, capital gain will be calculated, and long-term capital gain, it will be a long-term capital gain. And tax liability on the long-term capital gain on sale of RSU is 20% in India. Then if employee saves the stocks within 2 years of holding, then short-term capital gain will be calculated. And in India, short-term capital gain on RSU is taxable at slab rate. So if the employee is falling under the 30% slab rate, then the capital gain arising on the sale of RSUs within 2 years, which is short-term capital gain, will be calculated at 30% plus surcharge plus EC, whatever will be applicable. Now we will discuss the examples of the taxation of income generated from RSUs and the implication of tax reporting requirements. So first of all, we will discuss about the dividend income. So Mr. A, holding 140 shares, received the dividend. For example, basically these examples are hypothetical examples. So Mr. A, holding 140 shares, he received the dividend of $200, for example. So dividend earned will be $200. And suppose rate of exchange is 80 per dollar, then dividend income will be reported in income tax return will be 200 into 80, that is rupees 60,000, 16,000. So any income generated in foreign currency, we have to convert that income to the INR at the specified rate. The rates are specified in income tax provisions. So we have to consider those rates, and we have to convert income from foreign currency to the INR. And this dividend income will be reported in income tax return, and tax liability will be calculated on that dividend, and it will be paid. Now, second example, in case of capital gain, suppose Mr. A has number of shares, and out of which he sells 40 shares in the next year of vesting. So it means he is selling the 40 shares before 2 years of completion period. So in that case, short-term capital gain will be calculated in the hands of Mr. A. And if he is selling those 40 shares at a dollar 190, then short-term capital gain will be calculated as a difference between fair market value as on date of vesting and sale price. So basically here our sale price is 190 and there will be some fair market value for those shares as on date of vesting. So difference between these two amounts will be considered as a capital gain. Now this amount will be in dollars, but we have to convert the amount from foreign currency to the INR because we have to declare the amount in income tax return and we have to calculate the tax liability on the INR value. So for the conversion, you have to take the sell value, the rate of exchange as on date of sell, and for the purpose of fair market value, you have to take the rate of exchange as on date of vesting. So you have to convert the sell value, you have to take the converted sell value with the help of rate of exchange as on date of sell and converted fair market value rate of exchange as on date of vesting. And you have to take the difference, and the difference will be considered as a short-term capital gain and tax liability will be calculated as a slab rate, on slab rate. Suppose Mr. A sells 70 shares after 3 years of vesting. So in this case, he is selling the shares after completion of 2 years. So in this case, long-term capital gain will be calculated in hands of Mr. A. So suppose Mr. A says 70 shares at $220. So the difference between sell price and fair market value as on date of vesting will be considered as a long-term capital gain. And again, we have to convert these values as on the sell value at the rate of exchange as on date of sale and fair market value as a date at the rate of as on date of vesting. So the difference between the converted sell value and converted fair market value will be considered as a long-term capital gain and it will be taxed as a 20%. So now to conclude, we will take some important points for discussion. So RSU holders should take care of reporting of dividend income and capital gain income while filing their ITR. So if you are a RSU holder, you have to take care of some things while filing your income tax returns. So if you're holding your stocks and if your company is distributing the dividend, then you should calculate your dividend and you should declare your dividend in the income tax return. So in case of RSU's dividend income will be reported same way as we report the Indian dividend in the income tax return. Second thing, if as a RSU holder, you are plan to sell the capital, you are plan to sell the stocks, you are plan to sell the shares, then in that case, you should take care of calculating the capital gain and you should report the capital gain properly, short-term capital gain and long-term capital gain with the proper heads. For that purpose, you have to consider the period of holding properly and then you can consider if it is a short-term or long-term. Then if you are RSU holders, then you should take care of reporting your balance units held as on 31st December of financial year. You have to report that balance units in your income tax return with the date of acquisition, peak value, and closing value. For example, if you're filing return for financial year 2023-24, so in that case, you have to declare your balance units held in your account as on 31st December 2023. Then RSU represents ownership interest in company and granted to employees as a part of salary. So basically, RSU are granted to employee in the first year of employment, but that does not mean that employee are in ownership of those stocks or shares. Until and unless the shares are vested to the employee, employee cannot deal with the shares, cannot sell, or cannot is not eligible to earn the dividend income. Then RSU are usually vested in the several years, and upon the uh, fulfillment of certain conditions which are specified by their employer at the time of employment only. Then, upon vesting, RSU are subject to taxation. So, as we discussed earlier, whenever RSUs are vested to the employee, the perquisite is calculated and it is added to the salary income, and TDS is deducted by employer, and employee is eligible to claim that TDS in his income tax return. Then on sale of RSUs, employee has to calculate the loss, capital gain or loss, whatever is there, and subject to period of holding, he has to classify its short-term capital gain or long-term capital gain. And the rules to consider short-term capital gain and long-term capital gain are different as compared to the Indian stocks. So you have to take care about that. So I mean, there are certain confusions that whether RSUs are treated same as Indian stock, but it is not. The rules to calculate the capital gain in case of Indian stock and calculate the capital gain in case of RSU are different. So we will discuss some additional points to take care while filing for RSUs. So first of all, dividend income in case of RSUs will be reported same as a normal income, normal dividend in India. And in income tax return, it will be reported at the same place where the normal Indian dividend is declared. Then capital gain on RSUs will not be treated as same as a capital gain on Indian stock. There is a difference. Indian stock capital gain on Indian stock is regulated by section 111A and 112A, but the same section will not be applicable to RSUs, since the 111A and 112A is applicable only to the listed stocks, and RSUs are not listed in Indian market. So because of that, the 10% rate for the long-term capital gain and 15% rate for the short-term capital gain is not available for the RSU sell and capital gain on RSU. And 1 lakh exemption is on long-term capital gain is also not available in case of RSUs. Perquisite will be reflected in Form 12BA, which is also known as annexure to salary, annexure to Form 16. So, if you want to understand that how much value is added to my salary on for the RSU vesting, then you can check your Form 16. You will see that amount in your perquisites column, and you will see the value of value added. And also these amounts are reflected in payslip also in case of employees. So about return filing, ITR 1 and ITR 4 cannot be filed in case of RSU holders. I mean, RSU holders have to file ITR 2 and ITR 3 only, because even though there is no dividend in case of RSU, or there is no sale of any stock and there is no capital gain income, still they have to report their balance units in the income tax return, so that, and that is not available for the ITR 1 and ITR 4. So that's why they have to file ITR 2 and ITR 3, even though they have not they don't have any dividend income or capital gain income. Generally, when you plan to sell the RSUs, RSU has I mean, there is a big gap of amounts, difference between the amounts. So RSU generally have a huge amount of capital gain. And so when you have a huge amount of capital gain, and there is also no provision of TDS or tax withheld for the capital gain income. So you, being a RSU holder, if you are planning to sell any stock, then you should take care of calculating your taxes in advance, and you should consider the payment of advance tax in the year itself to avoid the interest liability on the tax that which was not paid in advance as an advance tax. Basically, advance tax we have to pay in 4 installments. So if, for example, you are planning to sell your RSUs in the month of August, then you should consider the computation of taxes in the month of August or September, and you should consider of paying advance tax on that capital gain in the month of September, and so that you will be able to avoid the interest burden on that tax liability while filing the income tax return. So many times we see that people are not aware about this. So they don't calculate the taxes in advance and they don't pay the advance tax liability. And then at the time of filing the return, they calculate their capital gain, and then there will be a huge tax burden, the tax on capital gain, and there will be interest on capital gain. So being a RSU holder, you have to be very careful while dealing with the RSUs. If you're planning to sell them, you should calculate the taxes and you should pay the advance taxes. And if you have a dividend income, then you should report the dividend income properly in income tax return. And if there is any tax with it, then you can claim the benefit of that tax with subject to the provisions of DTA and fulfillment of conditions to avail the foreign tax credit. So I hope you got the points related to RSUs and taxation of the RSUs. If you have any queries, you can comment down in the chat box or you can reach to us. Thank you for listening me very patiently. Thank you so much.